Resurgent India Knowledge Series presents live webinar on NBFC fintech funding landscape, role of private equity investors. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers: Mr. Subit Saurav, Associate Partner, Cedar-IBSI Capital. Mr. Siva Vadivelzhagan, Investment Director, Mudge Invest. Ms. Remika Agrawal, Director and Country Head, Creation Investments Capital Management. Mr. Rajat Bansal, Director, Lok Capital.
Yeah, good evening, friends. I'm Ashish Agrawal from Resurgent India Limited. Resurgent India Limited is a leading investment bank, CB registered merchant bank, having Pan India presence. Resurgent India is the organizer of this webinar, where we are organizing such kind of webinars since last more than 3.5 years. And we have conducted more than 150 webinars of such kind on different topics. This webinar is very important from the financial market point of view and from the BFSI sector, especially the NBFCs and fintech. At the current juncture where the regulator is tightening the rope and industry is also growing, and there are many such challenges which are facing by the industry in terms of the regulation and in some cases we have seen the portfolio challenges also, which we will discuss in detail in the webinar. But friends, if you see this NBFC space, we have this ecosystem since last many years, and more than 9,000 NBFCs are registered in India with RBI. Out of that, I think something around 1,500 NBFCs are there which are active, and they are having the different products which they are lending to the ultimate borrowers, and they are helping in the economy in terms of providing funding to the unserved and underserved category of the borrowers. As you know that India has 60% population in the rural part of the country. So the many people who are not having the access of the banking system, they are taking money at their doorstep, and they are getting the all kind of arrangement or all kind of facilities where they can deposit money, deposit the whatever the repayments are there through online mode and all. So the digital has also helped us to a lot actually, where through the digital transformation in India, and everybody has mobile also. This is also helping the overall lending companies actually in terms of reaching to the last mile customer also. So we will just run a small presentation. Before that, I would like to welcome to all of you on behalf of the Resurgent India and on my behalf for joining with us in this webinar, and specifically to all the panel speakers. Those are experts in this field, and they are practicing investments in the NBFC or fintech space in the last many years. They have invested in multiple companies. They have invested and gone through the journey, and they have exited also. Some of the companies which they have invested, they have become the bank also. So this is a good transformation from a small NBFC to a bank. So this is a very, very successful story which we will discuss also here. So I would like to thank you to Remika, Rajat, and Subit and Siva for joining with us in this webinar. Really, it's a great privilege for all of us that you are here and to discuss on the industry landscape in the current scenario. And I would like to thank you to the welcome also to the audience from the different part of the country and the outside of India also for joining with us. And friends, I would like to request you to please ask as many as questions you want to ask. We'll try to take the questions whatever possible. If anything will left, we'll try to give you the answer on your email ID later on, so that we can make it more vibrant, more interactive discussion. So before reaching to the panel speakers, I would like to run through a small PPT, which might give you some of the glimpses of the industry, what happened in the last 4 years in this industry from the private equity or VC investments point of view. So I'll request to my team, Ojaswa, to please run through the presentation. So friend, this is the first slide about the VFSI funding or the PE funding in the VFSI space. So this is we have taken from the latest report from RBI, where if you see that the overall VFSI space, there were investment or something around 2.25 lakh crore, which is in last 4 years actually. If you see, these are the BC and PE investment. And if we see out of that, in this last 1 year, well, the last 2023 first half and the 2023 of the 224 in the first half, there is a little decline in the overall amount actually. So it was 30,000, now it is 23,000 actually. And if you see the overall NBFC space in the overall BFSI segment, so it is 1/3 of the overall BFSI investment in last 4 years. So this was 260 lakh crore, 2.6 lakh crore. Now it is in the NBFC space, it is 88,000 crore actually. So and within 162 deals. So if you see in the overall VFSI, NBFC sector plays a very, very, very important role in terms of the volume and the number of deals also. And if you see the chart, actually, this whatever the bar is there, actually, the number is increasing every year from 20,000, 29,000 to it reached to 82,000 in 2022. And in 2024, it is 23,000 in the BFSI, overall BFSI space. So the major investment in BFSI investment was in 2022. Yeah, next slide. So this is on the based on the deal size and the stage also. So if you see, the late stage deals are actually more in terms of volume, in terms of overall volume actually. And buyouts, it were actually more in 2023, but in this 2024, this number has reduced actually. So the overall definitely, because latest stage size is bigger actually, so volume will always be higher. If we see on the numbers also, so definitely on the number side, number of deals, this early stage deals will be on the larger side actually. The next slide. In terms of geography, if you see the regions, we have covered 5 cities. There will be some other cities also, but majorly the investments have come in these cities, companies actually. So if you see, the major investment have come into Mumbai and Pune region actually, then the Chennai and Delhi NCR. So these are the major cities in India where the NBFC, BFSI companies are having larger presence actually. Yeah, next. Exits, if you see, there are good exits also, majorly from, if you see, major exits have happened in the IPO market actually. So this IPO market was very, very good in last 1.5 years. So many of the investors or many of the NBFCs have exited through IPO in terms of the dilution of their equity in the primary market actually. Yeah, next. Top 10 investment. So if you see, these investments includes buyouts also. So the Serum Housing, the Baba Pincus has bought over the major stake in the company, then Swatantrata Microfinance. So this is the list of NBFCs, where the NBFC or some of the fintech companies also like Perfios got the good amount of investment from the investors. So these are the, so out of 10 investments, if you see the 8 are in NBFC where the major investment have come. Practically, the NBFCs are leading in terms of the investment size also in last 1 or 2 years actually. Yeah, next. And exits actually, if you see FSI side, so Axis Bank, Policy Bazaar, and here other names also there. Other housing has come out with the IPO. So there are many IPOs which have happened in the last one year actually, and sizable IPOs are there actually. The next. From the investments point of view, from the series A, B, and C, so we have just tried to work out a table where we can showcase you that in last 1 year, how many companies have got the series A money from the various investors. So if you see that the 4, 5 names are there, which are those are the, I think, company which have got the investment first time, and the investors are supportive to them also. And even they were having the small portfolio, but the investors have supported them. And many investors are there those have supported them. And the sector wise also, if you see, the secured and MSME loans and the EV space also, solar also, then the business loans, home loans. So multiple sectors or multiple product are there where the investments have come in the Series A investments in the NBFC space. Yeah. Next. So like this Series B also, so there are such investments in the Series B, which is again, we see that there's a diversified sectors are there, rather not sector, I'll say products actually, where the investments have come. And next, in next slide. Again in Series C, so there are many names in Series C. Again Series D also. So Series C, the larger names are there, where many such investments have come. So it is not like that investment is coming in one category of either Series A or B, but it is across the all series actually. So this is good part actually from the private equity point of view, that in last 1 year there are many investments which have happened in the NBFC space. Yeah, next. IPOs also, we have already discussed. So if you see that these are some of the IPOs in last 1.5 years or 2 years other. Yeah, next slide. So if we see from the NBFC point of view, because this discussion which we have today is on NBFC and fintech actually. So NBFC credit is growing. So this is estimate that it can grow between 12 to 14% in 2 years. And if you see that this housing and infrastructure, I think having the larger number of larger percentage in the overall NBFC space. And if we see the rural India is, I think, helping a lot to grow this portfolio, because still we have under penetration in the rural market, which is untapped to some extent actually. So these new players are coming, and they are rather the larger players in the NBFC space are reaching to the last mile in the rural areas to the borrowers. And then the geopolitical instability in other countries also, I think, in helping to the NBFC to get money from the other financial investors also. And maybe the on the borrowing side also, they are getting borrowing also. The next slide. So market scenario opportunities for investor, if we see that still, so still more than 1,000 NBFCs are there which are not funded, and they are growing, and they are backed by the good professionals. So the league is changing now. Many of the professionals who are working in the industry, and they have good experience of lending, and they are now coming up in their own journey. So if we see the average experience of the promoters in the new NBFC, something around 15 years actually, and they have good corporate governance also. So this is a opportunity, I will say, for the private equity VC investors to invest in the Indian market, and these companies can grow like anything in the next 5 to 7 years, and they need the guidance also. So as an investor, you have a lot of experience of investing and then getting from the investment, scaling up these companies also. So these people look for guidance also along with the investments. So next slide. If we see the just a case study of AU Small Finance Bank, so if we see from the Series A investment in 2010 and till 2017, till the time they come out with the IPO. So the first valuation in 2010, it was something around 129 crore or 130 crore something, And if you see when they have exited in the 2000, so they have brought the IPO that time, it was 44,000 crore. I think this was 10,000 crore. So we see from 130 crore to 10,000 crore actually in 7 years. So there are, I think, opportunities for the investors and for the NBFCs also to get into that private equity funding and then grow their companies. Actually, they can become like AU maybe after 5, 7, 8 years actually. And you have seen the journey. Many NBFCs have become the bank. Earlier, they were NBFC or MFIs. So the roadmap is already there in the country for the NBFCs. The good NBFCs can definitely get the chance to become the small finance bank. Actually, later on they can become the universal bank. So this is something which I would like to present all of you because some industry point data points which can help you to connect with these data and understand what has happened in the past and what are the opportunities in the future also. So this is all from my side in terms of the presentation. And now I would like to come back to the panel speakers for their deliberation. And as I told you that all are stalwarts in the industry and they have seen all ups and downs in the industry also, and they have invested in the companies and they've scaled up these companies also. So we have Ms. Remika Agrawal from Creation Investment. She's head of country on the investment side. So Remika ji, first of all, welcome to you. And we would like to understand from you, I think, little more about the Creation Investments. What is your mandate for India and how was your journey in terms of investment in the various NBFCs? I think I was seeing the list. I think you invested more than 15, 20 NBFCs in India in different sectors and different size also. So we'll be happy to know more about you and your company. So over to you, Remka ji.
Thank you, Ashish. Good evening, everyone. I'm Remika Agarwal. I'm a director at Creation and I head our India office. Our India office is based out of Bangalore. I have experience of more than 18 years in the financial services space and I've been with Creation for 5 years now. Creation Investments is a Chicago headquartered fund manager. We focus on companies which are in the growth stage with a mandate to specifically look at companies in the financial services space and those which have a impact thesis. Currently, we are investing out of our fifth fund, and our total AUM is more than $2 billion. India is a major geography for investment for us, Ashish, and we have many great companies, portfolio companies in India, including Vivriti, UB, Vastu Housing, Oxyzo of Business, and so on. Like you said, we've invested across many companies, many NBFCs, HFCs in India. And we have also exited quite a few via IPOs as well as strategic acquisitions. So our portfolio is diversified across the financial services space, across different asset classes and products that are available there.
Thank you so much, Remika ji. Thank you for briefing about your organization and about yourself. So now I would like to invite Rajat I think you can brief about your. So first of all, I would like to welcome you again on this panel and would like to know more about your organization and about yourself, Rajat.
Sure. Thank you, Ashish. Hello, everyone. My name is Rajat Bansal. I'm a director at Lok Capital. We are a India-focused impact investment firm, one of the earliest impact firms to be founded. We were set up in 2004, quite strongly focused on financial inclusion and financial services as our thesis. We are currently investing out of our fourth fund, and in the last 20 years, we've raised in excess of 350 million across these four funds and have also exited the first two funds completely. We're currently in the process of exiting our third fund and deploying the fourth one. Some of the companies we've played a role in some cases, helping set up with a seed stage or a just post-seed investment, or in other cases, played the role of a growth equity investor. Include names like Ujjivan, Utkarsh, Veritas, Vistar, Aptus, and Umeed Housing Finance. A large part of our initial microfinance portfolio got the small finance bank license. So we've seen that transition very closely and a very exciting phase for that sector. So in a sense, that was the first 10 years of our journey as low capital. Last 10 years have been much more focused on secured lending. So a lot of secured MSME as well as affordable housing finance that's been the focus, and increasingly looking more at the fintech space as well. Ticket size wise, we can start with something as low as $4 to $5 million and go up to $20 million. So we say Series A and B as our core focus area. I have been in this space since 2010. Earlier in a treasury role at one of the leading NBFCs, and then in an investing role for the last 10 years. So I've seen a fair bit of the sector and lots of cycles and ups and downs. So over time, I think, uh, I don't know if it prepares you better for the next cycle or not, but it's always exciting when the next one comes. So happy to talk more about it during the discussion.
Thank you, Rajat. Thank you so much for giving such insights about your company or your organization. And so, first of all, Siva, welcome to you. And would like to understand more about yourself and about your fund also. I think Mage Investment, you have presence in various other countries also. So if you can cover up to some extent about your experience in other countries also, if possible.
Yeah, thank you, Ashish, and good evening, everyone. First of all, thanks to the all Resurgent India team for having me on this webinar. My name is Shiva Vadivelalagan, and I'm currently the Director for Investments in MyInvest Financial Inclusion Department. MyInvest is basically an asset management company headquartered in Copenhagen in Denmark. We manage close to about $18 billion in asset under management. And of course, this is across multiple strategies. We have our own value fund, we have our own mutual funds and private equity funds. A chunk of it is invested in Denmark only, but then we have a very niche, thematic and focused private equity funds, 3 of them, which fall under the Mage Invest Financial Inclusion Fund. So those are the funds that I manage along with my colleagues in offices across the globe. We have an office in Peru, which takes care of the Latin American investment, and then the office in India looks after investments across Asia and a little bit of Africa as well. And as far as the corpus of these 3 funds, as I mentioned, is about $400 million. In that sense, we are one of the largest dedicated funds that invest only in financial services, and we've been doing this business since 2010. In that sense, we have been quite long-standing in investing in this space. The first fund was started in 2010, the second fund in 2015, and the latest fund that which we are still active with investments is about since 2020. And some of the investments we've made in India includes iFinance, which is into unsecured lending, and then you have Finova, which is into secured lending. We've also invested in Flexi Loans, which is more digital unsecured lending. So as you can see, we have a flavor of different business models within the lending and financial services space. As far as the size and stage is concerned, we come in at Series B onwards, go up to Series C, Series D, with the ticket size of about $10 to $20 million, and further follow on with additional capital with our portfolio companies. So I've been personally associated with MyInvest since 2019. I come with about 13 years of experience in private equity and private debt. Prior to MyInvest, I had worked with other asset management companies in Europe, looking primarily after Asia Pacific region, with a strong focus in India.
Great. Thank you so much, Siva, for giving insights about your experience and the international presence also of your fund. So now we have Sumit Saurabh. Sumitji, first of all, welcome to you. And I think you are into early stage investments. So a lot of our people who are here actually listening to you, they would like to understand more about your fund and yourself also. So how you are helping these initial stage investments and all. So over to you, and please brief about yourself and your fund also.
Thanks, Ashish, and hello, good evening, everyone. First of all, thanks a lot for Research in India for having me on the webinar. I'm Subit Saurabh, Associate Partner at Cedar-IBSI Capital. We are sort of new kid on the block, unlike the other funds, people presenting a more established funds. We're early stage and specifically banking tech focused fund with a target corpus of around 250 crore. Our focus segment stage is pre-series A stage, basically tech one or two paying customers. That's the stage we prefer. Our investment size, ticket size, initial ticket is up to $500,000. And while it's a first fund, it's been slightly different from the fact that it is built on top of a platform with two sister companies. Both of them are 3 decades old. One of them is a consulting firm, the other is a research analyst firm. Both of them deeply entrenched in banking and banking technology ecosystem. And we believe that provides us the sector expertise point of view, as well as ability to leverage the knowledge that the platform is building, not just to select the right opportunity, but hopefully work closely with the founders and help them with insights and ability to grow the business faster, in addition to the capital that we provide. From this fund, the idea is to invest in 10 to 15 early stage companies. And as of now, we have done the first close early this year. We made our first investment in a AI context where platform called CogniQuest based out of Bangalore. They basically have developed a AI platform which can process unstructured data and document, which has multiple use cases in BFSI, both on the banking side as well as insurance. The second investment we are about to close, which has product on managing incentives across BFSI as well as the lending digital lending platform. So we are actively deploying these cases. About myself, I have a total of around 15 years of work ex. I've been with Cedar for the last 2 years. Before Cedar, I was working with Avishkar Capital, the Impact Venture Capital Fund, for 9 years. So that's about me and the fund. Happy to share my thoughts on banking tech during the course of the webinar.
Thank you, Subit. Thank you very much for giving the perspective of your fund. So friends, if you have seen, we have all panel speakers are having more than 10 years of experience, and they are ready to invest in companies from pre-series A or from the C to Series C. So you have the whole journey of the entire journey of your company they can fund actually. So that's a good part that it's our privilege that we have such investors. Those are keen to invest and they have invested, they have experience also. So we have some questions which we have just collected and we have to discuss with the panel speakers. So I'd like to invite Ramika ji to discuss the first question, which is very, very important. The current scenario also, and being we are merchant bankers, so we are interacting with not many NBFCs. When we are talking with them that you should go for the private equity and all. So many times we are listening that these companies are discussing that why we should go to private equity. We can go for IPO now. SME IPO is also doing well in the Indian market actually. So Ramika ji, you like to understand how as a fund you are helping to your investee companies in terms of scaling up in various ways, bringing the process and systems, so that instead of going for SME IPO at the early stage, they can go for maybe private equity and then get scale up, and then later on they can go for the main board IPO. So it would be helpful for all of these who would like to understand about this actually. Over to you.
Thank you, Ashish. This is a very interesting and important question. And before that, I mean, obviously, I think one thing which all of us understand is that NBFCs, MFIs, HFCs, lending institutions play a very important role in our financial ecosystem. They have widespread branches in remote areas. They can quickly do loan approval processes. They have also an ability to underwrite the informal segment. And because of all of this, they are able to provide access to credit to marginalized communities. But to be able to do this, they first need capital, which is absolutely essential. Now, this capital can be divided into two parts, which is equity and debt. So lending institutions which have access to more capital and at lower cost can provide the same to marginalized communities and to various other borrowers, including passing on the cost benefit. So to your question on why private equity investors and what role do they play, it's a very important one. Of course, they bring in the much needed equity capital into the ecosystem and into the companies. But these investors, the private equity investors with their experience in relevant sectors, are also able to strengthen the companies they invest in and make the companies more attractive for debt investments. So, one of the elements which the PEs bring to NBFCs is stronger governance and focus on strengthening their systems and policies. They oftentimes also work with the companies on strengthening the management teams as needed. Being vigilant on compliance and remaining on the right side of regulation is super important. And private equity investors who invest actively in the NBFC segment are able to bring that culture and learning to the NBFCs which they invest in. So many investors also take active board seats and are actively involved in building the core of the companies. Hence, it's also important to partner with those investors who understand the financial ecosystem, regulatory landscape well enough to work together with the NBFCs towards an aligned vision and help them grow and subsequently move to the main board IPO. So investors also spend time with the management on various aspects which influence the financials of a company, eventually leading to better growth and numbers for the company. So the growth capital which the investors bring in help the NBFCs also lever up and reach out to banks, FPIs, other NBFCs for debt. Lenders obviously draw comfort from the equity which the NBFCs have, but also look at the financial strength, management strength, compliance, governance, and all these elements. And it's important to build that out right in the beginning and in a more structured way. All these factors also play an important role in determining the rating of the NBFCs and how the rating journey goes. And strong equity backing, capitalization, diversification of a lender base, all of these, amongst various other parameters which I just spoke about, help in improving the rating of the companies and eventually leading to lower cost of funds. So ultimately, the capital received, the cost benefit can be passed on to the borrowers, and all this capital together can help strengthen the company and lead to a better outcome of the company. And IPO is just one of the outcomes. So there is a lot of growth story that goes behind it.
Thank you so much. So you are saying that not only investment, you are helping them in the growth of the scaling up of that company by way of bringing management, processes, systems, everything, and regulatory aspects also, which is helping to grow fast. And if they are going for IPO, SME IPO kind of this, actually these kind of things will not come along with that actually, because diversified investors are there, but nobody will be in a position to help them in their process and everything. So I think getting money is one thing, but how to scale up, how to get this kind of know-how, I think once you are going with the private equity funding or VC funding, this can help you to grow faster and in a better way also. So thank you, Remika ji. I think you covered very well this question. And like you, everybody, I think every investor is helping their investee companies in such a manner actually. So good. Thank you once again. So Rajat, I'll come to you. I think you have seen in last, last 6, 7 months, since last 6 to 7 months, RBI has increased the risk weight on the unsecured kind of portfolio, and the RBI has also come out with some of the guidelines on that also. So would like to understand the unsecured versus secured loans, how the investors are looking for such journey, and because in your portfolio, I've seen that you have companies which are into unsecured lending also, secured lending also. So regulatory doing something, but from the investor point of view, how you lens these companies or how you lens this portfolio. So we would like to understand if you can highlight on that.
Yeah, that's an interesting question. And I will not speak for all investors because everyone has their own strategy and preference. I think from our perspective, the way we think about it is not if it's secured, unsecured. For us, the primary focus is the end customer. So, interestingly, the slide that you put up in Series A, you had 4 companies listed there. 2 out of those, we've come in as the Series A investor. One happens to be secured, one happens to be unsecured. The end customer for both of those companies actually looks very similar. I mean, keeping apart the fact that one is more North and Central India focused, the other is more South focused. But typically, these are micro enterprises. These are either kirana stores or small textile stores or some kind of hardware stores or services businesses. So for us, what's important is it a good customer and do they have a credit need that can be served? Now, if let's say only 10 or 15% of the total customer segment has a property that can be put up as collateral, that doesn't mean that the balance 80% should be starved of credit. So when you apply that lens, it's important for both of those segments to get access to credit in a professional way from a formal service provider. So that's the starting point for us as a thesis. Now, your point is absolutely right. The risk profile of the two asset classes is absolutely different. Unsecured is a lot more prone to, so it has a much higher beta, which shows not just in the business, but also if you track these companies on the listed market, the way the valuations and multiples move, you will see a much higher beta there. So in some sense, they're more prone to getting hit by credit cycles. And that's something I think over the course of multiple cycles, we've built into our thesis. And we look at these businesses from the lens of you can't always time the cycle. So you need to be patient. You need to think of these as long-term investments, and you need to work with the company knowing fully well that you're backing a play which is unsecured. The other non-negotiable for us is a very clear focus on risk and credit in the founder group. And that's irrespective of whether it's secured or unsecured. Now, the NPAs for one segment might be higher, and therefore, in a risk-based pricing construct, you pass on some of that cost to the customer. But it's absolutely essential that the founder and management team focuses on underwriting as well as collections in the right way and don't so internally we classify companies as whether they're cowboyish or homeboyish. So we ideally want homeboyish or homegirlish companies. We don't want cowboyish founders to be running lending businesses on their own balance sheet. So when you apply that lens, I think it makes it slightly easier to work with the companies across cycles and help build value over the long term. And we've done that across different segments, starting with microfinance, now increasingly with unsecured MSME lending. So all companies will go through cycles, I think. And from a regulatory perspective, the regulator's job is to make sure that systemic risk is contained. And they're doing that to the best of their ability. We are doing our jobs in terms of supporting the companies with capital as well as a lot of the other value added kind of elements that Remika referred to make sure that we set the company up to become a large company, to hit the public markets at some stage, and ensure that all of that is done in a structured manner.
Great. Thank you. I think it was a very tough question in this current market. You have taken up very well. And you rightly told that it can be built up in the pricing risk, whatever the risk is there. If you're pricing right, the risk actually, then practically doesn't make any difference whether they say secured or unsecured actually. So that's good. I think it's a very good answer also. Thank you so much. So Shiva, now I'll come to you. First of all, welcome to you. Shiva, if you see this NBFC, also there is a lot of competition is coming actually. Even if you see the BT, balance transfer, top-up loans, the number is increasing, percentage is increasing when we are seeing the data on quarter to quarter. So, as an investor, how do see this kind of scenario, and you see that you have already invested in some good companies actually, and then you have seen them growing also. So when you are identifying companies for investment, how you do identify these opportunities that this is a good company, this is not a good company for you. So some kind of recipe which you have in your system, if you can discuss on that, that will be helpful to all of us.
Sure, Shisha. I think it's a very interesting question. Right. Maybe I just start off with our general thesis of how we've been doing business in since almost 2 decades here in India in financial services. When we are talking about NBFCs and lending, I think it is not a winner-take-all market. There is an opportunity for everybody to grow sustainably. We've seen companies in our portfolio growing very healthy, while they are competitors in some sense. We are invested in 2 microfinance companies, we are invested in two secured lending companies, so on and so forth. And that's also the reason why you see, there's a lot of private equity and private capital chasing this opportunity. I think the market is massive, but yes, there is a bit of competition in a healthy manner. So I wouldn't be concerned with the competition. I would like to point out on the emerging trends within the NBFC space, right? I think it's going to be broadly categorized into 3 types of companies or 3 parameters in which NBFCs can excel to get the attention of private investors. And build a healthy business for themselves. Now, first is there is going to be a clear drift between those NBFCs that are traditional or suffering from some sort of a legacy system issues, and those which are more nimble and tech oriented. I think the ones that are more tech oriented will seize the opportunity that is there in the market and serve clients more efficiently and conveniently. Second is the trend where we are talking about the niche. I think NBFCs that are focusing on more niche sector or focus sector, like that of MSME NBFCs that are doing MSME finance only, or NBFCs that are doing EV financing. I think that's the trend that's emerging. Those that are doing broad-based businesses, I think they're going to face some margin pressure. And lastly is the aspect of compliance and regulations. I think it's very important that lending as a business, RBI has made it very clear that you don't need to be licensed and you need to adhere to prudential norms, so on and so forth. So I think those that are good with compliance and on the ESG aspect and responsible lending, those are the trendsetters, is what I feel. I think in a way now you would also guess that I'm coming to the point that as a private equity investors, if the companies are able to ace in these parameters that I mentioned, then we also feel very comfortable doing business with them. Right. So in that sense, if the company is focused NBFC, if the company is good on compliance and governance, and if the company is able to tap on the technology aspect of the business, then that's something we feel very comfortable around. And finally, I think, as a Series B investor, Series C investors, I think maybe Subit and Rajat would do this differently. But for us, there's enough and more financial data points. The proof of the pudding is in the eating. So we have numbers that speaks for itself. So we see, healthy ratios, and we take it as a cue that the company needs capital, and then it could execute the same thing that it was doing before and build business from there on.
Okay, got it. I think thank you so much for giving the insights, how you identify these companies and how you select these also. So I think corporate governance or the focus and technology, these are the 3 key points which you have given actually. If these 3 points are there, then you can evaluate and then you can take it further for the discussion actually. Thank you so much. So Sumit, first of all, welcome to you again. And Sumit, you are actually catering to the entirely different kind of companies which are at the very early stage. So as you know that there is a risk also when you are investing in the very early stage companies, and there may be chances of more failure rather than success. Also, their successes are also there. So we'd like to understand the strategy of your fund, actually, how you identify or how you basically evaluate these companies, the early stage companies, actually, whenever any such opportunity is coming to you in the fintech space, or I would like to understand also, you are investing only in fintech or you are investing in NBFCs also? So that will be helpful also. Yeah, over to you.
Sure. So as I mentioned during my introduction, that it's a fintech focused fund, and within fintech, what we're focused on is more on B2B side of the ecosystem. So we are focusing on banking tech, or in a simpler way, you can say any tech company, tech product company, which is servicing BFSI segment. That is the segment that we are focused on. And very interestingly, if you noticed, my co-panelists mentioned three things while their focus is more on the operating company. But there are three common things where that these operating company need to be efficient, right? They need to be very mindful of the risk that they're taking, and they need to be compliant, right? And in a very interesting manner, while we focus on product tech companies, the focus is on the same trinity. We look at companies which are helping operating company either to become more efficient, or to manage the risk in a better manner, or helping them to be more compliant, right? So that is how we categorize the companies, and in a broad manner, as I mentioned, we'll repeat that these need to be, for us, need to be tech product companies building for BFSI, right? You also mentioned that the risk of early stage, which is always there. For us, we are not investing in idea stage company. We are looking at the promoter groups who have developed the initial, I would say, PMF product and have at least couple of paying customers. We validate the problem that they're trying to solve. It also helps us take a slightly deeper look in the how large the problem statement is, and whether that can be expanded to for this company to have the opportunity to become a large enough company or not. Right? Just to give you a couple of, I think, example which should clarify. Let's take the example of the first point, which is building efficiency. One of the key point which an operating company has is in terms of distribution, right? One of the companies, this is a second investment that will be closing, and they have a product which is for BFSI segment to manage the incentive management, right? And this product is equally useful for lending institutions as well as insurance institution. I'll take the example of the insurance institution because there the use case is more complex, and hence it can be more easily understood. As you know, insurance companies have multiple distribution channels, right from direct salespeople to agents, brokers, bank assurance, you say whatnot. Then you add to the complexity that these are selling different products. Each product usually have different incentive, which is what driving the sales. Incentives sometimes even differ from region to region, in the manner that if they are selling in tier 2, the incentives are different than if they are selling in tier 1. And then you top it up with a mapping of hierarchy in many to many while distributing incentive, and it becomes quite a complex problem to solve, right? Very surprisingly, when we are looking at this segment, most of the larger companies were still solving this in a very, very manual fashion. And that's the opportunity that we identified. This company, the product they build is a micro modular product, which means that the insurance company can choose which modules are relevant for them. While it is a full suite product, right from onboarding the sales team to doing the calculation of their incentive, and publishing in a very transparent manner in a dashboard for management as well as the salesperson, that whatever sales they made, how much they're earning. Right. But as a company, you have the flexibility or liberty to choose the module which you think is more relevant for your company. And that is getting enabled by the micro modular architecture that they have. The second point is they've also built it in a very low code manner. What it means is that for every change or configuration that the company want to do, it can be done at a business user level. And they have the ability to run various incentive program on their own rather than running back to a tech support team for every changes. So that's just an example of the kind of tech companies that we would be funding. And as I said, the guiding principle is that it should be solving, either bringing efficiency, helping the company to mitigate the risk, or helping them to be more compliant.
Very good, Sumit. I think you have very well covered also that because the initial stage companies, there are risks also, but there are good opportunities also to scale up these companies fast actually. So friends, we have discussed on many parts of the many things which are related to the NBFC funding, secured versus unsecured, also scale up and all. Two key things are there which are, I think, important to discuss in this forum. One is the valuation. So this is a common question. I think anybody can take it actually. So will help us because everybody has their own strategy for the valuations. And the second one is the specialized NBFC, which are in the new age NBFC, which I'll say that EV, solar, or maybe some kind of healthcare funding companies also. So the first question which is related to valuation. So if you can throw the light on the valuation multiples, the current scenarios, although they depend on company to company. If you think any range which you can give us or give, highlight here actually, and which are the factors which are impacting the valuation, so that the industry people who are here actually they can understand that these are the ingredients that these are there in my company, then I'll get the better valuation actually. So this is one question to all of you. So Remika, you can take I think lead, and then others can also discuss on that. So over to you.
Sure. Thank you, Ashish. And while I cover this, maybe there's also a live question on what investors look for while investing. So maybe I'll just touch upon that along with this question. So, but before commenting on valuation multiples, I think it's important to maybe the second part of your question, what drives valuation. So one of the key factors which is considered is earnings, specifically when we talk about the price to earnings multiples for lending companies. Now, there are several factors which drive these earnings, including NIMs, which are themselves driven by portfolio yields and cost of funds, and other important areas being operating cost, provisions, and of course growth. So while one looks at the current levels, understanding how these aspects will play out in the future is important when one looks at the multiples. So expected growth rate on an overall basis, as well as across products and segments, competitive pressure, and their impact on yield, for example, or potential rating change, and their impact on cost of fund will drive the future NIMs. So the regulator has also been very watchful of the yields charged by companies, and including the processing fee, which contributes to portfolio yields and not what many people talk about. And it is important to understand what is an acceptable range of yields for different products, which we closely look at. Similarly, from a cost of funds perspective, while rating and company performance are important factors, ability to negotiate better rates, partner with more lenders, curate different borrowing products, ultimately affect the cost of funds. And investors spend time in assessing this from the current level as well as future expectation perspective. Additionally, an important driver, like I mentioned, is operating cost or OPEX. The ability of a company to scale and manage or improve productivity are key elements that investors spend time quantitatively as well as qualitatively assessing. Since many lending businesses are also branch-led, understanding productivity and operating costs at a branch level also becomes key when one projects out the OPEX levels. Provisioning is another important element in the profile, which is determined by the quality of credit. And as investors, we spend time understanding the credit underwriting mechanism, the monitoring mechanism, the strength of collections, before arriving at any credit cost or provision expectation, which is an important element to drive the future earning. So, nature of the underlying loan products like secured and unsecured, tenure, all of this gets baked into the parameters which I just mentioned and ultimately drive earnings and the ROA, ROE expectations. So, both the trailing PE multiples and the forward multiple becomes important. Additionally, the price to book multiples, something that we often talk about, is also used to look at valuations. A key factor which, while considering the price to book multiple, is looking at the leverage of the companies. So having an optimal level of leverage, in my opinion, is healthy, where one is able to leverage the capital, however, at the same time, not be so stretched that the capital raising becomes an immediate requirement. The ability to leverage also helps gain confidence in the company's growth prospects. So many a times we've seen companies with strong growth outperform peers. Like in the listed markets, we have HFFC and Bajaj Finance, who have pretty good valuation multiples. So valuation multiples, of course, get impacted by the overall macroeconomic scenario, like we are seeing now across the NBFC segment. A difficult environment can lead to, sometimes lower growth prospects in the near term, as well as maybe more provisioning. So investors do look at past track record of the companies to navigate through the macro headwinds. So there are cycles that different asset classes may go through. There can be, the unsecured segment may be going through a different cycle vis-a-vis the secured segment at the same time. So all of this has a direct bearing on the multiples. Hence, when one looks at the multiples, it's important to look at projections and assess multiples through the cycle, and not just go by the current trends.
Okay. So anybody would like to contribute to that, Rajat, Siva, and Suvit? Just to add, so I'll just to add on that actually. So if you see many times when we are talking to the founders and the companies, they are coming out with that this company has got this valuation or something around 5, 6 times, 7 times of the book multiple, just to be very example based actually. And then we are talking to them, we are giving some other indicative numbers and all. So they are saying that you are quite conservative in the valuation thought process and all basically. So why the such difference is there in the valuation multiples actually from 6 to 3 or 2, whatever maybe basically. So variation in these multiples. So is there any math for that, any standard for that, or depend on various other factors? So if anybody can comment on that, I think that will be helpful. And sometimes people are coming with a DCF valuation actually. They said, as per this 5-year DCF, this is the number, and I should get this much valuation actually. So as an investors, if you can highlight on that, I think the realistic picture will be helpful to all of us. So over to you. Anybody would like to contribute to that?
Yeah, I'll quickly take a shot. Sorry, Shiva, I'll just finish quickly and then go ahead. I think Remika explained it quite well in a lot of detail. While listening to her, I realize how much work as investors we do without realizing it. But I think she covered all of those areas because oftentimes it's easy to just compare, okay, X company is getting a 4x. Why are you quoting a 3.5x to me? But there are so many factors, a lot of them being subjective. I think what's important for founders and other stakeholders to also understand is it's important as investors for us to be able to invest and deploy the capital that we raise. So we are incentivized to invest, but ultimately our long-term incentive is so that we make a certain amount of profit. So it's always that push and pull that plays out in the investor's mind as well. And to the best of our ability, we try to price it right. And I think the market today is competitive enough that no one will get away with a very conservative pricing just because the company does not have options. You always have options of multiple investors. There's enough data out there. So broadly, it will fall in a range. And ultimately, it is a market driven process. So the market will get to a certain multiple for every company. Individually, either as investors or as founders, one may or may not agree with those multiples for any given company, but I would, at the end of the day, respect the market. And it's the same thing on the listed market as well. You'll have similar looking assets being valued differently by the public market. It's difficult to put a very scientific model behind it, but I think a lot of the intangibles that go into it is actually what does sometime end up playing out in the market.
Okay.
Sorry,
Okay.
Shiva, why don't you go ahead?
Yeah,
No, I think Rajat and Remika had covered enough and more on this topic, but just an observation and how we have been valuing companies on our books and when we do new investment is, lending. I mean, before I say that, the logic is that lending as a business is very unique, right? Where you have the product is also capital and your raw material is also capital. So, in that sense, it's really about how much leverage you can do in your business and grow that business. So the equity or the net worth of the company is very important. It's also regulated. You can't cross beyond a threshold. You need to raise more capital when you do that. So price to book is a metric that we follow. But of course, you have price to earning and price to AUM and many more these days, which can be used as a proxy for this kind of multiples. And of course, DCF, I think, Ashish, you mentioned, I've seen some of our peer investors and we ourselves use it, but that has a lot of assumptions also inside. So it's very subjective exercise. That can also be taken as proxy. But at the end of the day, as Rajat also mentioned, right, it is a business that's been there for a very long time. There are much larger entities that are listed and are trading at certain multiples. So there is a market that's already set what could be the kind of multiple ranges, and that is seen as a proxy when a new investor is making a new investment in a company at Series B or Series C. But early stage, I think it's a very different exercise altogether about how much investment you make and how much ownership you get. Probably Subit could add more on that.
Yes, Subit.
Thanks, Raj. No, as you rightly said, Ashish, I think two different differentiation. One is given the companies that we look at, these are tech companies, so and at early stage, so they are either just have started making revenues or they've just got initial MRR or ARR. So valuing them on a specific multiple sometimes become very difficult, unlike at a later stage. So one part, a few things that goes into consideration is that we try to bucket when you're looking at a tech product is right now how we have built a framework is that do we believe that the tech product is completely disruptive, right? And while the use cases are still evolving, but do we believe that in the next 4 to 5 years, this can disrupt the market and grow at an exponential pace. The other bucket could be that there are other players in the market, but the product, from a product point of view, is better, more efficient, and hence will be able to compete with the existing players and still create a market for itself. Right? And both the bucket, the slightly, I would say, premium is obviously given to the company which we believe has built a more disruptive product, because the outcome can be completely outsized. Right? But and in a long-term view, we also try to look when we look at the tech companies that obviously the SaaS multiples are in the mature markets are established. So you try to see if the companies will be able to get there or not. But broadly, what Shiva mentioned, that how much company is raising at that point in time, what dilution we are comfortable with, the promoter, of course, comfortable with, that also plays a role in that.
Okay. Thank you, Subhita. I think so for evaluating the early stage company, there are different method and the thought process is there. But for the company which are having maturity or little bit matured companies, I think price to book is one of the major criteria which has come out with the discussion, which can be the major. Then the proxies can be there, maybe the AUM to kind of price, or maybe there can be other factors which I think maybe comparable also from the listed market can be there also. So it's not a simple thing to value a company. I think there are multiple factors are there which I think impact the valuations. So whenever anybody which looking to raise equity, I think these all factors should be considered as per the this discussion. So now the second, I think the question which is the climate tech or climate related lending like solar rooftop or EV funding, or maybe specialized NBFC which is healthcare financing, or maybe the education. Education is already, I think, lot of company, many companies are there which have grown now. So as an investor, how do you think that this sector or this kind of companies can be funded from the investment point of view, or do you have any different take on these companies or these sectors? So there are some people who are already the founder of these companies and they are listening all of us. So it will be helpful to them how the investors are looking for investment in such kind of. Although these companies are very early, because early in the sense they are not having very large portfolio. So when the portfolio, I think, well, say the seasoning of the portfolio is not that much, I think, old actually. So keeping in mind these things, how do you think that you can invest in such kind of companies, and would like to discuss on such specialized funding companies also? So over to you. Anybody would like to take this question will be helpful.
Maybe I can start quickly. So
Yeah.
I think the three segments you covered: climate financing, education, healthcare. Probably these can be 1 hour webinars on each of these in their own right. But quickly covering each of the three. So I think climate financing and education for us, especially, are areas of focus, and we've been evaluating most of the businesses that have come up. And while we club them in these categories, there are a lot of nuances in which areas they're targeting. So EV versus a solar rooftop, for instance, within climate, and then a lot of companies also do more wholesale or fleet level financing or leasing kind of products. Similarly, in education, you have education abroad, you have upskilling, you have coaching, you have domestic higher education, which potentially is a very big market, but also from the look of it, a slightly risky market. So not many people have been able to crack that. Healthcare for us has not been too much of a focus, and that's partly a function of the overlap that that product has with health insurance per se. So it's difficult to say where a use case for a healthcare financing ends and where it should be covered with health insurance. So we've looked at it more like a continuum, and probably our view is that health insurance is a better way of covering it than pure play financing. But definitely interesting spaces and a lot of potential in each. Like you said, Ashish, still a little early, especially in the case of climate. So we need to see how the assets actually end up working across a full life cycle, and then build a better sense. But at an early stage, we've been evaluating a lot of these opportunities. And while we've not made an investment yet, we're quite excited. I think next few years, these areas will get a good amount of capital.
Okay, thank you so much. Yeah. So Siva, would you like to comment on that, or?
Yes. So just to add, maybe we being on the Series B onwards, haven't had the opportunity to work with companies that are very much focused in only these sectors, climate related or EV related. But that said, it's also a space that more mature companies are also tapping into as a way of expanding their product offerings. There's a lot of innovation that is going on. Maybe just for example, I can talk a bit about one of our portfolio companies, Namdev, where we invested this year. The company is primarily into secured MSME lending, loan against property and business loans. But about 10% of their book is in EV financing and solar financing. And that product and that portfolio has been performing extraordinarily well. It's been zero NPA and has been growing very much as per the target and as per the budget. So I think that's also because since it's a new product and there's new opportunities, the seller is also willing to give some subventions, and in that sense, it's protected against possible risk or defaults. So that's also the reason why I said there's a lot of innovation that's going in productizing the loan offering. So I think that trend will continue. I think more and more ESG focused NBFCs are coming up. And I think investor sentiment also remains very strong because we see there is an opportunity and we see there is a lot of social good that can be delivered.
Okay, thank you so much. Okay, so Subit and Remika would like to comment on that also, or if possible, otherwise we'll pass on.
Sure, Ashish. So as a fund, we are focused on financial services companies. So obviously EV finance, education finance, all of these do come into the area that we do look at actively, and we have looked at companies in this space. Commenting on, and there are some really good companies which are working on the education finance space, companies which are dedicated there, to reasonably fewer in number compared to other segments. Coming to the EV finance space, like I completely agree with Siva that there are companies which are larger and who have products that they have created in the EV finance or MSME kind of green finance or solar finance. But even there are smaller companies which are coming up, which are exclusively focused. I think one important area, and that is where perhaps OEMs also need to play an important role, specifically on EV finance, is how to give more comfort to the lenders, because some of the challenges which I've heard of is, for example, servicing of vehicles, or spare parts not being available, or resale value of the vehicles. Now that is not an established market yet. So can OEMs buy back the vehicles, giving more comfort to lenders to lend to customers? Because typically what lenders do is, what we have seen is, they try to match the tenure of the loan to the battery life of the loan, battery life of the vehicle. So if there can be a repurchase assurance, then perhaps there can be more LTVs which can be offered, or better rates that can be offered. Similarly, I think though there is on the funding side, I think the green bonds, etc., have picked up in a much bigger way globally, and I think my colleagues here would would have looked at this globally as well. But in India, there has been limited penetration of green bonds and limited uptake, though there have been some examples. But if such bonds can be offered at better rates, then NBFCs could also pass on some of the cost benefits via subvention to the borrowers. So, yeah.
Okay, thank you so much. So Sumit, I think there are a lot of, because you are funding to tech, banking tech and all. So you see that RBI, the government of India, has mandated that the solar rooftop should be there, of this much of number of solar rooftops should be installed, subsidies are giving. Many banks are gearing up for such kind of funding, but still they don't have technology to reach to the ultimate borrower and fund for such kind of assets actually. Even the EV also, the technology evaluation and all these things, as Remika has also told, the servicing of vehicle or repossession of vehicle or the resale of the vehicle also. So do you think that the companies which are in such kind of technology solutions and partnering with the banks will be of your industry companies in the future?
So Ashish, I think if we take a step back, right, it's a very exciting time. I think, as all my co-panelists mentioned, more and more specialized NBFCs are coming up, right? they are focusing on a specific customer segment or a specific asset class or a specific financing vertical. And the reason it is happening, in my view, because two reasons. In fact, one, the founders believe that it is a large enough space to create a focused niche NBFC. And second, they also believe that the traditional players who have been operating, whether because of their lack of flexible processes or the lack of their backend tech to support those flexible processes, they are not able to cater their segment. Right? So they are seeing this opportunity where a niche focused NBFC can be created. And now, if you look at the second problem that I mentioned, that the legacy system that are being used by the traditional players, if that is a challenge for the traditional players to not offer more personalized, more customized products to tap into this emerging segment, right? So that creates an opportunity for banking tech companies who can create more modular, more configurable, whether you talk about a loan origination system or other systems, which can become basically the platform of choice for this NBFCs to cater to new asset classes. Right? Because for all these new asset classes, the traditional, whether you talk about the onboarding process or the origination process or the credit evaluation itself, the traditional models are not going to work. It has to be customized based on the asset classes. People need to come up with different credit scoring model. People need to come with different workflows. And that means your system need to be agile and flexible enough to allow you to do all that. Many of the legacy systems that are significantly larger market share lack that flexibility, right? And that provides a significantly large emerging opportunities for founders who are looking to build tech product in this sector.
Okay, great. Okay, so such kind of specialized companies or maybe the tech companies can also have the chance to get funded, and maybe they may be small as of today, but later on these portfolios can be large also, keeping in mind the requirement of I'll say the country also. So I think we have covered a lot on the NBFC side or fintech side from the investment point of view. And also, I think we have overshoot our time also. So there are some questions. I will request to the panel speaker if they can take 2-3 questions. That will be helpful. So we'll take maybe not more than 5 to 7 minutes. So will it be okay? Can I take these questions? I'll take these 2-3 questions. I think quickly we'll try to cover up these questions. So I think first question is from the Professor Prakash Singh. I think in light of what happened in Nabi, how do you guys see the role of regulator in the BFSI space? So I think this is a very sensitive area actually in the regulator point of view, because you see that regulator has their own I think thought process, and they are trying to do many things. So from the investor point of view, I'll skip this question because they are not the right person to reply on that actually, because ultimately it's a regulator prerogative actually. So we'll pass on this question. The second question, which is there actually, what is the thumb rule for valuation apart from all other factors mentioned, as we have heard in multiple of AUM, multiple of net worth, or both? So anybody would like to take this question? Although we have discussed, so any thumb rule for the valuation? If do you think that any such thumb rule is there?
I think maybe I'll just take a crack at this first. I think from a lending company's perspective, again, lending companies, platforms, the models are very different. Some platforms may take much longer time to break even, and the journey is very different where they are more focused on growth. So again, depends on the kind of companies that one is looking at. But typically for lending companies, one looks at price to book multiple, which is, maybe you can call it multiple of net worth, or a price to earning multiple typically. Some other companies which are more in the service oriented space, like for example, more in the SaaS kind of space or the platform kind of space, perhaps looking at a revenue multiple could be another way to look at this.
Okay, got it. The next question is, we are looking for PE fund for next phase of growth. Can we have a call? Understand? So I think definitely you can call directly to the anybody of all of you. So I think that will not be a question also. I think next question is, there are some startup NBFC which have raised funding basis, business plans, and even before NBFC license. And there are others where the founders have invested their own funds, have brought the company to a certain scale. Within the limited equity means, beyond which equity base becomes to manage the liability. But lack investor interest given the visible track record to analyze. Why is such an approach from investors? So they would like to understand many such companies which have not started even the license, they have not had the license. They got the funding, and such companies are there which are already having some business, but still they are not getting funding. So any comment on that, actually, why it is so? Any specific answer is possible of this question? Because
Yeah,
there
I
are such
can
cases
take that.
actually where the company like, just for example, India Shelter and all, some companies got the money in the account even without getting the license also. Maybe the license was under application actually. So any of
I'll
such example which you have in your investing companies also, which can be related to that.
We have done a few seed stage investments. It's never been without a license. So our investment always goes in once the company has received the NBFC or the HFC license. But in that case, it's very clearly a call on the founder or promoter group and their ability to execute the business. So I won't comment on any specific case unless it's a part of our portfolio. But in all cases that we have funded, it's always been the track record that the founders bring in their previous organizations. So in a way, you're using that as a proxy for saying, if someone has built a housing finance business in the past, executed it very well, then they can always execute it in a new company where they're the promoters as well. So that's the thesis we have. I think and we funded companies in Series A where that's the second category, Ashish, that you mentioned, which is they have some track record, they've gotten to a certain scale with the own equity that promoters have brought in, and then we've supplemented that equity with our capital. So the fundamental lens that we apply doesn't change. It's the confidence and the trust that we are able to build with the founders that drives that decision.
Okay, great. Got it. Okay. The last question, what is the entry level for PE investor in NBFC dealing in unsecured MSME? So any specific answer for that? Any threshold in terms of the portfolio? I think that there is the question, minimum portfolio.
So maybe I'll just try to take a stab at this, right? So, since the question says private equity, I'm assuming it's more when, the company is at a mature stage and not venture capital. So in that sense, first we need to understand, which unsecured business are we talking? Microfinance is also unsecured. You also have unsecured to, MSME, slightly larger ticket size is also unsecured. So first, it's about the customer segment that you're addressing. If there is more risk, then obviously you have you command slightly lower premium. And then second is, what's your delivery channel? Are you a traditional brick and mortar company that's having a high OPEX, and or are you more digital savvy company that is more efficient, and you have a more faster and larger approach to your delivery channel? Then again, you command a premium. So just since I mentioned microfinance and digital and secured MSME lending, I would say microfinance, the entry is looking at where the market is trailing. It can be below book value also, and it can be that could be a starting point. But if you're looking at more digital secured unsecured lenders. You don't have a proxy in the listed space because these are emerging NBFCs, and that commands a little bit of premium. So it's anywhere between 2-3 times kind of an entry multiple, and goes upwards also. That's how at least we've been seeing deals happening in this space.
Okay, great. Okay, so friends, I think we have already covered all the questions from the audience, and we have discussed on many other aspects of the NBFC funding, the overall landscape in the country. And so now I would like to end this session here, and I would like to thank you to all the panel speaker, Remika and the Sajat and Siva and the Sobit for sparing time with us, your valuable time from your busy schedule, sitting in different cities also, and you could get time for this kind of discussion. So I would like to thank you on behalf of Resurgent India and behalf of myself, on my behalf also. And I would like to thank you to all the audience or the people who have joined us from the different segments, different part of the country also. They have made it more interactive by asking the questions. So because with your from your question, we have also learned something. So thank you to all of you, and thank you to the Resurgent India team for organizing this program and making it successful also. So Ojas and Aishwarya from the investment banking team, and then Ayush and the other team members from the DM team, actually digital marketing team, for organizing this, because without your efforts, we cannot be the part of this program actually. So, and I hope that with the discussion, there will be, I think, some understanding, better understanding of the PEBC funding in the NBFC space and the fintech space. And I'll request to all of you, if you want to connect with the any of the panel speaker, you can directly contact them, and they will try to help you also if you are looking for some funding. And if anything is required from Resurgent India point of view, please let us know also. So thank you very much. Thank you all for your contribution in this program. Thank you. Thanks a lot, actually. Thank you, everybody. Thank you.
Thank you.
Thank you,
Thank
Ashish.
you.
Thank you,
Thank you.
everyone.
Thank you.
Thank you so
Thank you,
much.
sir. Thank you, sir.
Thank you so much.